Good morning, welcome to GrainTV. It's August 30th, 2012. I'm Logan Burgess. To my right is Cody Bills. Cody, let's jump into fire tip here. See how the grains are trading here this morning. Looks like we have a little bit of a pullback here in the market in general. Kansas City wheat leading to the downside, down 8 cents right now. Looks like the dollar index here is moving a little higher. Crude oil backing off about $1.30 there a barrel. Not a lot of big news out on the market. One thing that the market was watching closely though this morning was the export sales report. Can you kind of give us a rundown of what we saw there?
Yeah, absolutely. But before we get into it, I just want to mention that September contracts are going into first notice on Friday. So we need to make sure anyone out there that is hedging in the September contract that you're going to want to end up rolling that into the D's contracts for the grains, just so you don't get stuck with any sort of delivery. But let's actually get right into the export sales this morning. Low side expectations is where we mostly came out. Corn actually ended up missing expectations to the downside. We saw net reductions in old crop sales. Beans, we also saw net reductions, but we really had great new crop sales. That's where we really excelled, and I'll talk a little bit about that later on. And wheat came in right around analyst estimates at 508,000 metric tons. Let's look at old crop corn. We're in week 51, so just about wrapping up the old marketing year of 11-12, and we're 27 million bushels behind what the USDA is forecasting. So quite frankly, I think in the next report we're going to have to we'll see a continuation of what they've been doing, which is reducing their export sales estimates for the 2011-2012 crop. If you look at beans, this is old crop as well. It's a completely different story. We're ahead of pace 38 million bushels. So we're going to have to see the USDA most likely revise their estimates higher for beans, lower for corn. That's kind of what I expect to see. But look at sales for new crop beans. This is one thing that people have talked about. We've seen no real curbing of demand. We've seen no demand destruction in the export sales. We're 58% sold relative to the August, what the USDA anticipated. So we're running ahead of pace to get those sales done, and I don't see any serious demand destruction showing right now. There's no real indication.
Do you think this bean market needs to move higher here before we see that rationing?
Well, yeah, I think the bean market could move higher. I think that right now we're kind of paused and we're taking a breather, but I think most likely beans will end up having to move higher. We need to see some sort of indication. People are making sales because they're worried about new crop, but I think we're going to see or need to see some sort of indication that there's some sort of demand destruction to kind of curb the use of this.
Right, certainly. Well, one thing that's going to be affecting demand here moving forward, and something that kind of the macro markets are going to be watching very closely, is the Jackson Hole Economic Symposium that's been going on right now. Tomorrow morning at 9 a.m. Central Time, Ben Bernanke will be making a speech kind of on the state of the economy here, and a lot of market participants are looking for any indications of another round of quantitative easing coming out of that announcement. So we'll be watching that closely. One thing we wanted to do though here today is kind of take a look at how these QE3, or I guess how the past quantitative rounds of quantitative easing have affected commodity prices in general. Right now we're looking at a chart of the CRB index, basically a commodity basket here, heavily weighted toward energies, but corn, soybeans, cotton, and livestock all comprise 6% of this basket here individually, so certainly they have a strong presence there. And as you can see here, the first round of quantitative easing started in November 2008, went until March 2010. It's kind of in the shaded area in blue here. It certainly put a bid under the market here, kind of for two reasons. You know, when the Federal Reserve opens up the pumps, puts more money into the market here, all these commodities that are denominated in dollars have to become more valuable because the dollar typically pulls back during rounds of quantitative easing. But furthermore, the whole point of quantitative easing is to spur demand in the market. Obviously, demand is good for price, and as a result, we see it move higher here. If we take a look at the second round of quantitative easing, this here was between November 2010 and June of 2011. Very similar result. It was a shorter, the duration of the easing was shorter here, but it certainly had the same effect here. Right now, the big question is QE3 in the books? Are things bad enough to get Bernanke and the Federal Reserve to initiate another mechanism to stimulate the economy here?
Yeah, I think one thing that you want to keep in mind here is this is the commodity index. So So this isn't necessarily an indicator of whether or not they'd want to. Just because we're in a trough here doesn't mean that the Federal Reserve is going to want to do a QE3. They want to keep prices down. That helps the economy, but obviously the prices being down is more an indicator of the health of the economy and the demand out there for those commodities. So it is kind of interesting to see. Logan, I mean, you said that you don't necessarily see QE3 on the line here, or an announcement of QE3. What do you expect them to talk about in the meeting?
I think it's going to be a more general conversation of the mechanisms moving forward that could be used to stimulate the economy. A lot of people believe that QE2 was significantly less successful than the first round of quantitative easing. There seems to be diminishing returns from these quantitative easings. Obviously, they're going to wait until the situation gets very bad before pulling the trigger here on their third and potentially final time here. A lot of people are looking for that to be after the election. Obviously, there's a lot of moving components here. Politics is part of it. But it certainly does have an effect on a producer's bottom line here as it relates to the price of corn, the price of beans, and ultimately demand in the market.
Yeah, that makes a whole lot of sense, and we will be tweeting on this meeting here in Jackson Hole throughout the day on Friday. So stay tuned there. We'll see you tomorrow for the weekly wrap up. Thanks a lot for tuning in.